The trade war put is less likely to come from Donald Trump than it is from Congress, right? I mean, he hasn't shown himself to be much of a bluffer. He seems to be going through with everything that he says he's going to, but Congress could stop him in his tracks. They feel he's gone too far, it seems, with the Mexico tariffs. Do you expect that, Ben?
Well, I think the trade negotiations in general are some endogenous function of what's happening in the economy and what's happening in markets. And my guess is that the economy will, in fact, be quite sensitive to the Mexico tariff. Mexican tariffs, I think it's hard to overstate the potential damage they could do to the U.S. economy. Mexican trade is about the same size as China's trade. U.S. outward FDIs in terms of stock is about the same in Mexico as it is in China. And these tariffs are ramping up at a much faster rate. There's also the issue that normally we talk about who's paying for the tariff. Is it the sellers or the buyers? What is the incidence of the tariff? In this case, it's the same companies because it's a lot of trade between the U.S. and Mexico is intra-firm related party trade. And so this is either a hit to margins or a hit to inflation for the U.S. And I think that you're going to see that very quickly in the U.S. data, starting with sentiment. And so when that happens, and I don't think markets will be immune to that by any means, that's exactly when the trade war put is exercised. That's exactly what you saw at the end of last year and what would be our expectation from here. So the good news, insofar as there is some, is that you actually get an improvement from here when that put is exercised, but it may well get much worse before it gets better.
Okay, and you hold your nerve in the meantime.
Well, I think you have to be very vigilant in the sense that if you see the China tariffs and the Mexico tariffs ramping up as they have been announced, it's actually difficult to see that not be a recessionary scenario for the U.S. Okay. And so sentiment is really, really key here.
Sentiment is key, and I was hoping you've emphasized a lot of the bad news and a little bit of the good news there, Ben, because I was feeling slightly sad and depressed after I talked to my colleague Mark Covmore earlier on today, who was talking us through this chart. And of course, this is the Citi Economic Surprises Index, and it's had the longest run in the red since this index was created back in the early 2000s at least. I mean, this just goes to underline the point about how there is negativity in the data already. It's not as if we're sitting here waiting to see it show up in the data, the trade war and other factors. It's there already.
That's true. Let's try not to get too negative here. I mean, so you look at what happened in the fourth quarter of last year, a rapid deceleration of the U.S. economy. So the U.S. economy went from 4.2% in mid-2018 back down towards trend, which we estimate is 1.5% to 2%, and it did so very quickly. Historically, when you've had a 2.5-point move in U.S. growth, and you've had 11 since post-war, half of them have been recessions. And so there was a significant signal extraction problem going on in markets as to whether this is a benign slowdown to trend or whether this is the end of the cycle. I think what you're seeing as we go through the first part of this year is a mini version of that. And so the first quarter, you had the U.S. delivering on growth. You had China delivering on growth. Japan, Europe. You had a bunch of upside Q1 surprises. You mentioned a run of bad data. U.S. GDP in Q1 was 3%. And so what you're seeing in the second quarter, and you're already seeing this in April, is that you're getting some payback from that, which is setting up a bit of a difficult situation for markets in terms of signal extraction, because again, you have to sift through what is just a benign deceleration with something a little bit more sinister.
Okay.